Well, here we are. It's December 18th, about 2 weeks left in the year, and people are just waking up now to doing some planning. And there's a lot of great tax planning that still can be done before the end of the year. And one of the big areas that I think most people miss out on is the notion of charitable planning. And charitable planning is one of those areas that it doesn't get enough press, as I'll call it. So, first question is, who am I? Well, I'm John Gassman. We have a third generation firm. Started with my grandfather and my father up here in the Big Apple. We have global clients. My background is I'm a CPA. I'm also a certified financial planner. I'm a former chartered advisor in philanthropy. And philanthropy was always one of those things that was near and dear to my heart because my parents were always participating in events. They were always donating. They were always inviting people. It was important to give. So I grew up in an environment that fostered giving and philanthropy and that type of stuff. And by the way, if anybody has questions for me after this presentation, feel free. You have my email address, you have my phone number, you could connect with me on social media, and obviously you could send smoke signals from wherever you are because I can see smoke signals. So so here I am. I'm down in Florida a couple of weeks ago. I'm visiting my 95-year-old mother. And my mother says to me, I have to do some year-end planning, Jonathan. Come on, I don't like paying taxes. You're my advisor. Can't you do a better job for me? And I said, Mom, you got to be like kidding me. And she says, I'm curious, where do my tax dollars go? And I said, where do your tax dollars go? They go to Izzy, Robert, and Sam. They go to the government. So she says, I want to look it up. So she pulls up her laptop, and I know you can't believe a 94-year-old can actually, use LinkedIn, use Facebook. She is really technologically savvy. So she pulls it up. She Googles, where do tax dollars go? And poof, she comes up with the 1040 instruction booklet. And at the very end, there is a pie chart that shows where her tax dollars goes. And she's looking and she's like, I don't want my money to go here. This is unfair. I've paid enough taxes for 94 years. I want my money to go someplace else. So I said, Mom, you could be a voluntary philanthropist. You could send your money wherever you want. You can give your money to your children. You can give your money to social programs. You can kind of designate, if you plan properly, you can control your money. And she says, well, you're not doing a very good job, JG. That's what I'm called when I'm good. When I'm bad, she says, Jonathan. And then she says, Jonathan, you're not doing a very good job. So I think I'm going to use somebody else. And I said, go ahead, Mom. You don't pay me enough. So today I want to quickly share with you in the 30 minutes that I have, I want to share with you kind of the role of the advisor in philanthropic conversations, why it's important, talk about some updates in the tax law, and give you some quick, simple, single, doable things you could do between now and December 31st. And if you don't catch it by December 31st, assuming the tax laws don't change, guess what? You could still do them next year, okay? So that's kind of the way I look at this. Now, there's a very, very interesting US study report. It came about 2018. US Trust did a study on high net worth donors and their interactions with their advisors regarding philanthropy. And in an interview with Claire Costello, she was the head of philanthropic services, she comes up with a couple of really great points that I think are very important to guys like Alan, myself, and other advisors that are helping clients plan. And the quote I recall was, discussing philanthropy is good for the client. It's good for the advisor. And it's good for society because ultimately the advisor is potentially moving resources into public good that otherwise might not have happened without the advisor-client philanthropic discussion. Tim Cook, who ran Apple, once said, we want to be the pebble in the pond that creates the ripple for change. And that's what I look at that we do. So we're trying to help clients figure out what they can and cannot do, and how do they bridge the gap of where they are today versus where they want to be in the future. So the study came out and basically said a couple of things. One, professional advisors, guys like me, accountants, attorneys, wealth managers, are increasingly recognizing the importance of the philanthropic conversation. And they're understanding how important it is to the client. Over 2/3 of high net worth consumers share the view that having a philanthropic conversation is important. And furthermore, it goes through in the study, advisors think they initiate the conversation, but it's actually, if you really study and look at the report, it's the clients that more often than not bring up the conversation about philanthropy and charitable contributions. We look at things sometimes from a very technical perspective, tax savings, investment structuring, but what they want to talk about more than anything else is their values, their passions, existing philanthropy, the desire to get the family involved with their wealth. The vast majority of clients want their advisors to have these conversations up front. You meet with a new client, they want to start talking about this stuff. And again, I'm talking about clients, high net worth, and even uber high net worth clients. Advisors are typically increasingly having these conversations. It bridges the gap from generation to generation. And there's a direct correlation between the use of charitable vehicles like a donor advised fund, a private foundation, charitable gift annuities with building your clientele and your business. Again, huge correlative influence on those that get advice versus those that don't get advice. The number one thing high net worth consumers want to know if they're eager in learning about philanthropy, interest in kind of the different types of vehicles. Number two, they want to become more familiar with different nonprofits that focus on what they want. And number three, they want to integrate their values, their charitable goals into their wealth management plan. And again, big disconnect between what advisors say and what clients say. And it's not always about the taxes. Not everything is tax generated. So how do we start the conversation with charity with a client? So I may start a conversation and say something. Let's say I'm meeting Alan for the first time, and this is just one entry point before we get into some of the strategies. I may simply say to Alan, hey, it's great meeting you, Alan. Let's talk about kind of the goals you're looking to achieve. And in order for me to figure out how Alan thinks, I may ask a question like, Alan, let me ask you a hypothetical question. Let's assume for the moment we're sitting here. Let's assume for the moment you and I are sitting here, and you just found out that your aunt left you $5 million as a bequest. Wow, that's pretty cool, right? Absolutely. But there's a condition. For you to have the $5 million, you have to give away 30% of it to a charity. Which charity would you consider giving it to? Now, Alan's either going to say very quickly, oh, I'm going to give it to my alma mater, or I'm going to give it to this organization or that organization. Or Alan's going to say, I really don't know, JG. I never really thought about it. You know, it's like winning the lottery. It's like, I have to kick myself. I haven't really thought about it. So that lends itself to the philanthropic or the charitable contribution or charitable discussion. And these are kind of the couple of questions that I ask the clients when we're going down this path. Before I get to, let's talk about some strategies. I'll ask things about, you know, what are you deeply passionate about? You know, what motivates you? Family, faith, social causes. And again, I take copious notes, you know. Two, where can you do the most good? What causes don't get enough support that you want to have an impact on? Number three, which organizations address the issues you want to support? You know, let's do some due diligence. Let's ascertain how you can get involved. You know, how do you want to donate? Do you want to just give money? Do we want to give time? Do you want to be on a board? Do you want to be on a committee? What does success look like to you? And again, to the point of that Alan mentioned about strategic coach, I'll usually say something like, and this is a question that Dan Sullivan would usually, Dan Sullivan is the founder, he would say something, if we're sitting here an hour from now, what has to happen for you to feel like you got value from this conversation? I may say to the client, listen, Mr. Client, what does a win look like at the end in terms of your philanthropy? And that will lend itself to ultimately the conversation of how do we incorporate philanthropy and charitable giving in a meaningful, significant way. And remember, most people, it's not just about the taxes. Most of them are looking to give because it's important to them. It makes them feel good. They're making a difference in the world. Does that make sense? I'm sure it does, as everybody's shaking their head in the affirmative. So let's talk about where we are in terms of taxes. Well, the Trump tax bill changed a lot of things. It reduced the rates from 39 to 37%, and it also changed the way we take certain deductions. There's a cap on state and local taxes, as you know, to 10,000, right? People used to deduct their real estate taxes. There's state and local taxes, especially those in the Northeast. It was kind of significant. Now you have a choice of either door number one or door number two, as Monty Hall would say. Let's make a deal. You're either going to claim a standard deduction, which is a specific dollar amount, or you're going to claim itemized deductions, whichever is higher. So what you're seeing now are more and more of our clients, and I think the statistics are about 85% of those that file tax returns are now actually not itemizing, but they're taking a standard deduction instead, because the only thing they can deduct is their state and local taxes to 10,000, their mortgage interest, and think about a retiree. Do they have a mortgage? Typically not as much anymore. And their charitable contributions. So if they're married filing a joint return, are they getting over the $25,000 hurdle? Maybe not. And for those that, and this is important too, for those that don't itemize deductions, they're allowed to take an above the line deduction for either $300 if they're young and single, or if $600 if they're married filing a joint return. The CARES Act also made a very, very significant change because there are caps on how much you're allowed to deduct in a given year. It raised the amount to 100% for cash donations to a public organization. So in other words, if let's say I make $100,000 and I want to give away 80,000, I can deduct the entire 80,000 as long as it's a cash contribution to a public charity. I could go up to 100,000. If I go over my AGI, whatever is above and in excess will be a carryover into the next year. So that's a little history on where we are in terms of deductibility. Standard deduction or itemized. There are certain limitations and certain caps. So let's run through an example. And this literally just happened the other day. I got a call. It was on December 15th. My client, no, it wasn't Fred or Wilma, from the Flintstones, but it was a client that I kind of call him a Fred, a very nice guy. And he says, hey, JG, I just got my $100,000 bonus before the end of the year. What tax savings ideas do you have for me? And this guy he's a pretty philanthropic guy. They donate every year to various organizations. And he says to me, I'm thinking, I have this pledge for $2,000 a year to this organization. Do you think I should pay it off? And usually he's been actually taking the standard deduction, so he would not get a benefit for making, a $2,000 deduction. However, if he decides, hey, let me bump it up and give the other 8,000, so we'll get a total for the year of 10,000, he'll actually be able to itemize this year, thereby reducing his taxable income. So by bunching, several years of contributions into one year, he's able to capture a deduction. Now, what happens if you don't know who you want to give it to? Let's say you're sold on the idea of, okay, I'm into this. I could give away some significant money, but I just don't know who I want to give the money to. What's the answer? So the answer is we could set up what we call a charitable giving account. And I want to spend about 5 minutes talking about this because between now and the end of the year, these are probably the most popular tool or vehicle that's out there for those that want to lock in a deduction. So basically, what a donor advised fund or a charitable giving account, I call it, is basically a charitable account that's established by a public charity. That's all it is. It's just an account that's set up by a public charity. And it could be called, you could name it, you set it up as the Alan Gassman Charitable Fund, the John and Stephanie Gassman Charitable Fund. You could call it whatever you want. And the benefit is it's easy to set up. You get an immediate contribution. You could recommend grants out of this account for a period of time. And you've captured an upfront tax deduction immediately this year, even though it didn't actually go to the charities that you ultimately wanted to, but because it's going to a public charity that you have set it up with, you immediately capture the tax deduction. So what's involved with this? Well, A donor can establish the donor advised fund immediately. There's very little cost. There are several charitable sponsors, and all it requires is a stroke of a pen on filling out an application. Minimum contributions, and I'm not here to sell you on one organization versus another. We trade with Fidelity. I'm familiar with Fidelity's. The minimum could be just a $5,000 contribution to start, but the nice thing is you can add to it over time. And this stands in stark contrast to what I would call the private foundation, which can take months to establish, requires significant time, financial investment, and significant legal fees to set it up. So once the money is set up, once the account is set up, once it's established, the donor advised fund charitable sponsor, they handle all the paperwork. So that includes managing the investments, record keeping, tax receipts, grant administration. That allows you to focus on your charitable goals. By contrast, with a foundation, it requires a lot more work, time, energy, and effort. So do you control the donor advised fund? How much control does somebody actually have with one of these funds? So control is a key differentiator for a donor advised fund versus a lot of other giving vehicles. And we'll talk about another one shortly. When you as a donor, when Alan makes his contribution to the DAF, he's making a gift of cash or assets irrevocably to a public charity. And once that public charity accepts the money, it's theirs. It's not yours anymore. It's theirs. And again, the term donor advised fund is reflective of the relationship. The donor only has advisory privileges to grant assets from the account. That's it. Private foundation, again, you control it all. And again, when you look at the donor advised fund, again, you can't make grants to individuals. It has to go to a nonprofit. You can't receive anything in return, so it can't include a dinner at an event. You can't pay tuition for a kid, for a child. You can't use it for college costs. And these rules are pretty similar to those that are in the private foundation world. What's also worthwhile mentioning is the amount of the deduction is different. Right? The amount you can deduct to a public charity, you can give up to 100%, whereas to a donor advised fund, it's somewhere between 30% or 60%, depending on the specific type of asset. But if you're looking to capture and bunch deductions for charity quickly, this is a great way to do it. When we look at the donor advised fund, the nice thing is if you want to give, let's say, anonymously, you can give anonymously without anybody knowing where the money came from. So it has a lot of, it checks a lot of boxes. There's no minimum cost to it. There's typically no mandatory 5% distribution like a donor advised fund. So here's an example of a situation where client was going to give away, call it $100,000, didn't have the cash, so he was going to sell a security, pay the tax, and then whatever was left, he was going to donate to charity. So assuming capital gains rates roughly 20%, depending on the bracket, $100,000 fair market value, cost basis $5,000, there would have been a tax. Had he just sold the securities and donated the proceeds, he would have ended up with a tax of $11,000 roughly and a charitable contribution of $81,000. After our conversation together, and the way I would phrase this is, listen, if you're willing to plan a gift, Izzy, Robert, and Sam, the IRS is willing to forgive a tax. So by donating the stock and not selling it, donate the $100,000 to the donor advised fund, you now capture a $100,000 deduction, not an $80,000 deduction, and now you have saved $37,000 because of your tax bracket, and you didn't pay the tax on the sale. So I really, really think between now and the end of the year, this could be a very, very valuable tool for those that want to quickly get in their charitable deductions before December 31st, and it's use it or lose it. The second thing, and this has probably been the most popular this month, I have probably seen 5 of these across my desk, and that's what we call the charitable lead trust. The charitable lead annuity trust versus a uni trust. is a very, very unique tool. You know, it's a charitable trust. It's a great way to leverage your generosity, the family's generosity, while at the same time producing a very, very significant income tax deduction. And I'm going to walk you through the numbers in a moment. Essentially, it's the reverse of the charitable remainder trust. In other words, you put cash in or securities into this irrevocable trust. You're going to get this big tax deduction depending on the term that you've decided to pay the charity for. And then at the end of the term, whatever is left either will revert back to you or maybe it goes to your kids. So in a nutshell, it's a trust. It makes an annual distribution or more frequent distribution based on a term of years or based on your life. And at the end, whatever's left comes back to the family. And this is a great vehicle. So who's it suitable for? It's suitable for, let's say, if somebody who has a spike in income, significantly high income, and I'll give you an example, and they want to make a gift to a charity. And by the way, you could be your own trustee, and you can use a donor advised fund with this. So you can control the money going from your charitable e-trust to your donor advised fund. So this is kind of a very unique tool. So this is no story, as my father would say, story time. But last night I got a call from a client. I changed the name to protect the innocents. Tom and Jody, they're married, 2 kids. They live in New York City by Central Park. Yes, that's a lot of money. He made almost $30 million, and that was all predicated on his base bonus. He exercised some stock options because he was very, very concerned that next year's rates were going to be significantly higher. And he also accelerated converting from a traditional IRA to a Roth. So his income this year was $30 million. That's what it says on the pay stub, roughly, all the income added up. One of their kids is a special needs child, and they've been philanthropic. They set up a donor advised fund last year, and he's looking for more strategic solutions. So I said, let's look at the CLAT. This may be an interesting idea. We did this all on the phone, and I sent this to him about midnight last night. I said, so basically, here's a thought. I know you got a lot of liquidity because you exercise the options. So you're sitting on a lot of cash. You don't need it. So let's look at setting up a $10 million CLAT. Okay. And it doesn't matter. You could say $1 million. You could set up a CLAT with $300,000, but you want to make it valuable enough that it's beneficial to get over the cost. So, you know, $10 million CLAT, he gave me a rate of return of about 8%. It's going to pay out 5% of the initial principal for 10 years. So the deduction is based on the present value of the annuity stream. That gives them a 47% tax deduction on $10 million. It's a $4.7 million tax write-off. And at the end of the 10 years, whatever remains inside of that charitable trust, depending again on the market performance, is going to revert back to him and his wife. In this case, 14 million. Now we know that's a fallacy because depending on the performance, it could be up, it could be down. I don't know. So what's the downside with the CLAT? Well, irrevocable, number one. Number two, if you die during the term, it comes back into the estate to some extent. And number three, the downside is it's a grantor trust. So that means you have to pay the taxes on the annual income that it earns. So this could be, if you have somebody with significant assets, this may be a really terrific tool. Let me also share, and we're coming to the end, let me share with you something else, and that's called QCDs. These are very, very hot, qualified charitable distributions. And basically, like my mother, she doesn't really need the income. She doesn't need to take the money out of the IRA, except for the fact that the IRS mandates she takes her minimum required distribution, because if she doesn't, there's a 50% penalty. Because she's over 70, she can satisfy her required minimum distribution by taking the money from the charity, from the IRA, and sending it to the charity. She can't touch it. It's got to go directly from the IRA to the charity. So she never pays the income tax on that money. And for those that don't itemize, this is even a better way of making a charitable contribution. It's capped at $100,000, and you can't receive in return any sort of goods or services for this. So in conclusion, There are a lot of great techniques. I'm a big fan and a lover of making a donor advised fund available for those before the end of the year. Look at bunching the charitable contributions into one year if you don't get the benefit because you're taking the standard deduction. Consider utilizing charitable lead trusts as a terrific vehicle to make a contribution, big upfront tax deduction, maybe some gift tax, use up part of your gift tax. And then we have all these other tips, tricks, tools, and resources to kind of help you out with the various types of charitable planning ideas. But that's where we are for this year. I think we have a lot of great stuff to do between now and the end of the year, if we could do it. So I'll open it up for any questions or comments that anybody may have.
Jonathan, the first question is where would a private operating foundation fall in as a potential vehicle? Is that more like a public charity or more like a private foundation?
Yeah, so it's a good question, and I think we need, why don't you and I spend a day on, let's do a seminar just on private foundations, because private foundations offer a lot more, you and I both know that a foundation can offer a lot more flexibility than the donor advised fund, but it comes with it some costs, right? There are legal setups, you got to file an annual 990, there's public information, there are different limitations that apply, right? The 20 and 30% versus, let's say, the 30 and 60%. It's a great vehicle for those that can afford to have one. And especially, maybe you have an art collection, we could create our own museum or something. So I think there's a lot of great opportunity to leverage the use of foundations, all different types.
Right. And I would say, to the advisor, to the lawyers on the call specifically, I don't find the drafting of a private foundation or a private operating foundation to be difficult at all. It's much easier than a SLAT. It's easier than a revocable trust. So maybe our profession overcharges for these things because I don't have $2,000 to $3,000 worth of time to prepare one of these. It doesn't have to be so expensive. I mean, I've done them for people for a $10,000 donation so that they could get recognized in the community, and then they got excited and they put more in. But I don't think it has to be, mega dollars to do it. So another question is, with the $100,000 per year ability to transfer from an IRA to charity, is it really unlimited this year? Because you pull it out of the IRA, it adjusts your AGI up, and then so you could take $100 million out of an IRA, give it all to charity, and as long as you're not 59 and a half. So is that correct?
It's a very doable technique. We had a call the other day, Alan, with a client that they already maxed out the 100,000, each of them, the husband and the wife, and they're very philanthropic. They kind of knocked it out of the ballpark with one specific investment. And like, what should we do? And I said, listen, ultimately, it's the worst asset for you to leave to your children because it's subject to estate tax based on your estate levels, and it's also subject to the income tax. It's my recommendation. Number one, change the beneficiary designation. Let's leave it to charity. So that way the estate, as you know, gets a write-off dollar for dollar. Number two, I said, why don't you start giving now? Give with a warm hand rather than a cold hand. Don't you want to see your money being used rather than you're gone? You don't know what they're doing with it. So he loved the idea, and that's what they ended up doing. They pulled out about $500,000 between the two and just gave the cash away, and they got a dollar for dollar write-off. So great point, Alan.
So another question is, when would you recommend a CLAT, a charitable lead annuity trust, versus a charitable remainder trust?
Oh, great question. Great question. So I look at the vehicles as two independent types of vehicles. The vehicle for the charitable remainder trust, I look at it more for clients selling an asset. We're looking to structure an immediate sale, not have to pay the tax right now, look to diversify the portfolio, and we want to generate for ourselves an income stream, an annuity, a pension, whatever you want to call it, for ourselves for a period of years, and then the rest will go to charity. The lead trust, again, same thing. You're looking at getting an upfront tax deduction, but I don't want to sell an asset. So I would use the lead trust. I'd probably dump a lot of cash into it, not so much securities. And I would use the remainder trust to kind of sell a portfolio that's highly concentrated. Mr. So-and-so just retired from Pepsi. He's got $20 million of stock, $5 million of stock, but he's no longer at the company. He's concerned like, I'm not there. I don't have inside information. I'm concerned, how do I diversify out and protect my wealth? That's the answer for that vehicle, because remember, with the charitable lead trust, you're the grantor. So even if you put the highly appreciated stock into the lead trust and you sell it, you get tagged with the tax. The whole point in the remainder trust is not to get tagged with the tax right now and to pay the tax like an installment sale over a period of time. So they're kind of two different animals. They're two different vehicles. And with the low interest rate right now being what it is, the lead trust is more of the opportunistic plan for those with cash. And I think the charitable remainder trust really works very well for somebody that's got a highly appreciated asset and looking to diversify.
That's a great answer. It would really take, what, about 8 hours to cover these charitable planning topics to a reasonable degree?
You and I could knock it out in probably an hour and a half, because people are so smart. All the people that listen to you are so smart. They get it. So we could do it pretty quickly.
Yeah. Okay. Well, we'll definitely come back for part 2 when you're ready. And we thank everybody for your questions, comments, and suggestions. Send the easy questions to Jonathan. I mean, send Jonathan the hard questions. Send me the easy questions. Jonathan, one of the things I really love about you is your passion, both for people and for the financial world, and how you're able to help people unite, put those passions together. You know, so many people go to a lawyer or a CPA or a financial advisor and they get very sterile advice. It's like, hello, Mrs. Jones, you need a trust and you need a charitable. You care about Mrs. Jones, and you care about her charities, and you care about her children, and you care about getting stuff right, and you care about avoiding taxes. So hats off to you for that.
I think it's a Gassman thing. I would echo the same comment about you, Alan. There's no doubt about it. We're passionate about our people.
Yeah, we are. Okay, so let us know. A lot of you are professionals. I always enjoy you telling us what we missed or what we could add to our outlines. We'll bring Jonathan back as soon as he's ready. And I hope everybody has a fantastic rest of your Saturday. Thank you.